IT sector is one sector that has been focused. It has been gaining for the second consecutive session. And we have Abhishek Kumar, the IT research analyst from JM Financial, to discuss this sector in detail with us. To start off with, Abhishek, could you just give us a gist of what has actually been driving this kind of a rally that we have been seeing in the IT index? Because the EPS upgrades are not that much to support this kind of a rally, right?
Hi, good afternoon, and thanks for having me here first. I think you're right. Earning upgrades haven't come through yet. But if we look at the last few quarters, they were earning downgrades consistently, and that seems to have stopped. So that is kind of a first, you can say, milestone in inflection. Right. So the worst seems to be behind the sector. The demand commentary that we hear from most of the companies is that things are stabilizing. There are green shoots, especially in banking. And BFSI generally is a lead indicator for the broad-based recovery in the sector. And with rate cut on the anvil in US, some of the levered sector like telecom, manufacturing, etc., can also start opening up come FY26. So with these kind of anticipation, I think it's logical that investors will take position, and that is essentially driving the multiples up in the hope that earning upgrades will come through in due course of time.
Okay, that's a fair assessment. But do you think the investors are, being too ahead of the curve here? Because if you look at the valuations, they're still above or equal to the 5-year, 2-year averages that we have seen. So it's not cheap by any yardstick. And even if you look at the earnings performance, this year is expected to be low single digit. Next year, there's a question mark whether they'll be double digit or not. So one should actually look at paying premiums of, let's say, 30, 35 times for companies which are reporting single digit growth.
So that's an ongoing debate. I agree with you. The sector, especially the large caps, are even in good years probably will give low double-digit earnings growth. But I think what has happened, which explains, a structural uplift, I think in the margin or the valuation band, is that with the technology intensity increasing with the new technology like Gen AI, etc., the longevity of the earnings has really improved, and that kind of gives a slightly higher valuation if we just do the DCF. And so it is not completely unreasonable to see the kind of multiples that we are seeing today. But yes, this is in anticipation of earnings coming through, earning upgrades coming through, and if that doesn't fructify, then we can see some correction in the sector.
As you were mentioning that a rate cut cycle will benefit the BFSI space overall. So which IT company as per you would recover the faster or would benefit the most on the back of this recovery that we could see in the BFSI space?
Yeah, so I think among large caps, Infosys and TCS have higher exposure to US banking, so they will benefit more. Wipro also, given its exposure to consulting, because of the Capco acquisition, also is indexed to BFSI improvement in US. So these are the three large cap companies which I think should improve from the banking uptick.
Frontline, IT companies, TCS, Infosys, Wipro are the ones that come to mind. But on a risk-reward basis, on a valuation basis, on a growth versus valuation conundrum, which would be the stocks that you would recommend on the pecking order? Because a lot of mid-cap stocks have run up quite considerably. Case in point being Tata Elxsi, for instance.
Yes, so Alexi, we don't cover, so I will not be able to comment on that. But generally in mid cap, yes, the valuations have run up. So it is, prudent to have companies where there is strong earning visibility. And on that parameter, Persistent Systems and KPIT are our picks. Despite higher valuation in these two companies, the earning visibility is strong. The deal wins, etc., have been very, very consistent. And especially in case of Persistent, the high tech sector, which is almost 40% of their revenue, has not been performing, and with rate cut and demand improving in US, if high tech comes back, the earning momentum could actually accelerate for Persistent. So I think that is one stock which, despite higher valuation, we like.
Thank you, Abhishek, for joining us and for putting things into perspective.
If you like this video, then like, share and subscribe to ET Now.